Welcome back to Crypto Journal. Today, we're diving into the deep end of the XDC network, the digital asset, the technology, and the mystery surrounding its largest holders. Don't forget to like if you appreciate my straightforward content without absurd promotions. We're talking about the whales. For months, their colossal moves, the massive buys, the strategic transfers dominated the chatter. They created the waves we all rode, and their on-chain movements were often the primary source of market excitement and speculation. We tracked every large wallet move, scrutinizing the entries and exits. But lately, they've gone quiet. An almost eerie, sustained silence has descended upon the XDC on-chain data, particularly concerning massive exchange flows. This silence is what demands our attention today. Why? Are they finally exiting the market? Are they suddenly bored with the project they heavily backed? Or is this silence not an exit, but a sign of something far more significant and strategically deliberate? A meticulous, low-profile accumulation phase designed for a specific and ambitious target date, the year 2030? In this comprehensive 40-minute deep dive, we will meticulously break down the 5 primary, interconnected explanations behind the XDC whale silence. We'll expose the underlying fundamental catalysts and the multi-trillion-dollar market forces pointing toward a 2030 valuation target, analyzing the institutional framework being built right now. Finally, we'll give you the ultimate accumulation blueprint, the strategy, backed by historical precedent, that suggests the quiet period is the most profitable and least risky time for those with diamond hands and a decade-long vision. This is the long game of finance, playing out in slow motion. Stick around. What the whales are doing now in this critical silent window will absolutely define the next decade of XDC. The disappearance of large, trackable whale movements on public exchanges is, in our analysis, not a random event or an accident. It is a highly calculated and multi-layered strategic move. We believe there are 5 core, interlinking reasons for this persistent quietness, each designed to minimize market disruption and maximize their accumulation yield. The most immediate and technical explanation for the vanished volume is the OTC migration. Over-the-counter OTC trading means a whale simply cannot liquidate or acquire hundreds of millions of dollars worth of XDC on a standard centralized exchange without creating extreme slippage, causing a massive, undesirable price spike or crash. Such volatility, especially a spike, works against their goal of low-cost accumulation. Instead, they pivot to private, institutional brokers and dark pools. These brokers facilitate the trade directly between a single massive buyer and a single massive seller, executing the transaction entirely off the books of public, retail-facing exchanges. The transfer of ownership occurs, the multi-million-dollar accumulation continues unabated, but because the transaction never crosses the books of Binance, KuCoin, or Bybit, public on-chain trackers see nothing. For the retail investor watching the volume indicators and order books, the whale has vanished into thin air, when in reality, they've just taken their multi-billion-dollar game private and institutional. The second core reason is a direct function of the XDC network's core design, locking down the supply through staking and master nodes. This is a powerful, long-term commitment mechanism. When a whale commits a substantial amount of their tokens to run a master node, which requires significant capital or to delegate their stake, those tokens are immediately taken out of the circulating supply available for active trading. The XDC network, built for enterprise, offers attractive, secure staking yields as compensation for securing the network. For a holder with tens of millions of dollars, this passive, compoundable income stream is a powerful and low-risk incentive to lock away capital and generate revenue without selling a single token. This sustained locking mechanism is what creates a long-term supply shock. The more tokens that are perpetually staked and used for network security, the fewer are available to be bought, sold, or dumped, making the asset naturally more scarce and theoretically increasing the future value of their unstaked portion. Whale silence here means they are strategically securing the network, constantly compounding their staking rewards, and surgically tightening the available supply, the classic, irreversible setup for a massive pre-pump move. This next layer introduces the institutional perspective, regulatory compliance, and shielding. As XDC targets regulated trade finance, its large holders are often institutional funds, sovereign wealth managers, or highly regulated financial entities. Their activities are under increasing scrutiny. Large, visible, speculative moves on retail exchanges can be flagged by compliance departments and regulators as market manipulation. By shifting to private OTC desks and locking tokens into staking contracts, they are essentially shielding their movements. This demonstrates responsible, long-term holding aligned with governance, rather than aggressive, short-term speculation. Their quietness is a clear sign of regulatory maturity, positioning XDC as an institutional-grade asset suitable for massive capital influxes down the line. Moving to the technical side, the silence in whale movement directly translates into a very specific and highly bullish chart pattern, the extended consolidation phase. This is the phase of maximum psychological pressure. When an asset is in a long, boring consolidation phase, retail traders lose patience and interest. The price action is unexciting. This lack of excitement is precisely the tranquil environment the whales seek. You observe the price trading in a tight, often descending or sideways range. High volume, impulsive pumps are minimal, and panic dumps are absorbed. This tight range is the phase of maximum transfer. Tired retail traders, impatient investors, and short-term speculators get psychologically worn down and sell their holdings at or near the low end of the range. Who is on the other side of these small, consistent sells? The sophisticated, relentless whales. They are silently absorbing every token that hits the market, maintaining a tight price range to ensure their average cost basis remains as low as possible. They use advanced algorithms to split massive orders into hundreds of tiny ones, executed over hours or weeks, a technique known as iceberging, to hide their true demand from the market. The lack of volatility combined with a consistent, non-parabolic movement of accumulation is the classic textbook setup for a massive parabolic breakout. The lower the volatility is held, the more tightly compressed the spring becomes. And the longer the accumulation period lasts, the more explosive the resulting price move will be. The final, overarching reason is simply the 2030 blueprint. It suggests the silence is not just about trading logistics or charts. It's about a long-term, strategic accumulation phase with an ultimate goal. The target? 2030. This 7-year timeframe aligns perfectly with every major global adoption forecast for real-world asset, RWA, tokenization, and the digital transformation of global trade finance, which is the core existential use case for the XDC network. The whales are simply entering the waiting phase, knowing that the truly exponential, civilization-level gains will only be realized when the long-term, multi-trillion-dollar fundamentals fully materialize. To fully grasp the scope of the whale's 2030 strategy, you must understand the true scale of XDC Network's primary focus, RWA tokenization and global trade finance. The silence is the sound of institutional money positioning for a profound, multi-trillion-dollar global economic shift. Global trade, the backbone of the world economy, is an $18 trillion-plus market annually. But this colossal market is still inefficiently run, bogged down by outdated, paper-based systems, slow cross-border payments, and complex multi-party legal agreements. This is the exact problem XDC was engineered to solve. The network's unique hybrid architecture, part public, part private, allows banks, corporations, and government agencies to instantly digitize, verify, and execute trade documents like invoices, bills of lading, and letters of credit. They can tokenize these assets, unlocking liquidity previously trapped in archaic systems. The whales are not acquiring XDC for a temporary trend or the latest meme coin. They are buying a foundational piece of the digital plumbing for the future of global commerce. They are strategically positioning themselves for the moment when major financial institutions and governments must migrate to this efficient digital infrastructure to remain competitive. Market projections from firms like Boston Consulting Group and others are no longer whispers. They are clear, loud consensus. They predict the RWA tokenization market alone will hit anywhere from $10 trillion to $30 trillion by the year 2030. XDC's essential edge over purely speculative blockchains is its design for regulatory compliance, with its KYC-enabled masternodes and permissioned smart contract capabilities. This inherent structure is the non-negotiable institutional handshake that gives them the competitive advantage. Institutions must comply with global financial regulations. XDC is designed specifically to meet them halfway. If a sophisticated investor truly believes the market cap of XDC will grow 100x to become a key, entrenched player in this trillion-dollar RWA space, their overriding priority right now is low-cost, high-volume acquisition. They absolutely do not want to drive the price up with massive, visible public buys. They want to accumulate in silence at the lowest possible price for the highest possible return when 2030 arrives. This leads us to the accumulation blueprint, the long-term strategy that mirrors the successful actions of every generational investor, from Warren Buffett to early Bitcoin adopters. If the XDC whales are executing a 2030 accumulation blueprint, what does that mean for your personal strategy? Rule number 1, divorce your mind from the daily noise and the day-to-day fluctuations. The short-term price movements and the daily FUD and hype are functionally irrelevant to a 2030 strategy. The whale doesn't care if the price is 5 cents today and 4 cents tomorrow. They view the entire next 3 to 5 years as the last possible window to accumulate before mass, undeniable institutional adoption truly kicks in. Every single day the price stays low is for them a massive gift. Your action, if you align with the 2030 RWA thesis, is to focus ruthlessly on dollar cost averaging, DCA. Buy small, consistent, automated amounts, regardless of market sentiment, ignoring the daily volatility. This perfectly mimics the whale's desire for a low, protected, and stable average cost basis. Rule number 2, prioritize scarcity, not total supply. The true scarcity of XDC, the driving factor of its future price, is not its total supply, but its freely circulating supply. The more XDC that is locked up in staking, committed to masternodes, or held in institutional escrow accounts for future RWA settlements, the less is available for buying and selling. This is the scarcity lever. Your action, if financially and technically possible, consider staking or delegating your holdings. By locking your tokens, you participate in the quiet accumulation phase by earning more XDC rewards, and crucially, you directly contribute to the supply shock dynamic that will fuel the future parabolic price movement. Rule number 3, focus on institutional adoption milestones, not market caps. Stop obsessing over the real-time candlesticks and start obsessing over the key adoption metrics and partnerships. These are the only true catalysts for the 2030 vision. What to watch for? Official announcements of new banking consortia partnerships, concrete integration with major financial messaging systems like SWIFT, verifiable growth in the number of tokenized real-world assets flowing through the network, and crucial legislative/regulatory clarity in major financial jurisdictions like the EU or the US. The eventual signal that the whales have finished their quiet accumulation and are ready for the breakout will not be a random bull run. It will be the sudden, coordinated price explosion immediately following a major, institutional, non-speculative adoption announcement. That is the moment they know the foundation has been irreversibly laid and the explosive, long-term growth is inevitable. The sustained silence from the XDC whales is, therefore, not a signal of fear, confusion, or retreat. It is the resounding sound of perfect strategic positioning. It represents the highly sophisticated, long-term capital, the institutional players, the family offices, and the generational high net worth investors who have conducted the rigorous deep research and see the clear, unobstructed path to a multi-trillion-dollar RWA future powered by this network by 2030. They understand that the goal isn't to make a quick 2x profit this year. The singular goal is to secure the maximum possible amount of the foundational asset before the tidal wave of global trade finance and institutional RWA adoption finally hits the XDC network. The current period of low volatility, boring price action, and minimal public excitement is not a deterrent. It is the critical, once-in-a-cycle accumulation window. Do not be fooled by the quiet charts or the lack of chatter. The XDC whales are not asleep. They are silently, diligently eating. If you found this exceptionally deep dive valuable, please hit that like button, share this video, and subscribe for more essential, long-term crypto analysis. Question for you to reflect on. Do you agree that XDC's 2030 trajectory is irreversibly secured by the RWA narrative and its institutional structure? Let me know your realistic long-term price target in the comments below.